Are you trying to learn the difference between a HELOC and a home equity conversion mortgage? Well, my name is Trevor Carlson. I'm the president of Heritage Reverse Mortgage. We're going to talk about the difference of these two options and how each of them might be a benefit to you in retirement. And so the first thing to do is talk about what reverse mortgages are. HECMs is another term that we use for describing this type of loan. The easiest way to explain what a HECM is mechanically it's exactly the same as any other mortgage. Your 30-year fix, the mortgage you've had your whole life. You're borrowing money from a bank. You're going to be charged interest on the money that you borrow. But the one primary difference with the HECM versus every other mortgage is that payments are optional on HECMs. That means that if you live in the home, you pay your property taxes and insurance, other basic maintenance expenses, then you do not have to make a mortgage payment to the bank. And the nice thing about that is that you can stay in this home for the rest of your life. When you pass away, the home will be transferred to your family or your estate. They will inherit the home and they will have the choice to either sell the home and cash out any remaining equity, or they can refinance and keep the home and any equity that's left in it. But the point is that the beauty of this loan is it allows you to borrow money against your home without having that burden of a monthly payment. Now, one of the other benefits of a reverse mortgage, and let's talk about this now, and then we'll contrast how a HELOC is different. With a reverse mortgage line of credit, the money that you have available to draw from your home's equity is attached to what's called a growth factor. What that means is that if we did a reverse mortgage for you, let's say, and there's $100,000 of equity left over that you have access to draw, if you were to leave that money in your line of credit, it would automatically grow by the same interest rate you have on your mortgage. And so if you have a 6% interest rate, that $100,000 will automatically grow by 6% or $6,000 over the next year. Now, this is one of the features that makes not having a monthly payment and that growth factor really one of the two of the standout benefits of the home equity conversion mortgage versus really just about every other mortgage out there. The downsides, and I try to be very transparent with all of my clients. Reverse mortgages are not for everybody, and I don't try to sell them to everybody. I try to fit them with the right person because I know that if it's used properly, it will make your life so much better. But the downsides with the HECM are the upfront closing costs. These loans are guaranteed by the government, by FHA, and that means that if you were to outlive the equity in your home, or if we were to go through a market crash, and because you're not making mortgage payments, if your mortgage were to ever go upside down, you're protected from any penalties. That means that the bank can never come back on you and say, hey, you owe us money. They can't come back on your estate or your family and say, hey, we're losing money, you got to pay us. The nice thing is that FHA steps in, they cover those losses so that you don't have to. The downside to that coverage or that guarantee is that they charge high upfront fees. The alternative, let's jump to the HELOC, because that's usually what people are looking at is they're trying to find ways to consolidate debt. They're trying to find ways to have access to their home's equity affordably. And the HELOC is good because it generally speaking, it's a second mortgage. It will just come in right behind your regular 30-year fixed mortgage. It does have adjustable interest rates. And you can set it up, really a $20,000 line, $50,000 or $100,000 or whatever the bank will allow based on what your home is worth and what you currently owe. The pros of this loan are they're usually very easy to get. Generally speaking, 2 to 3 weeks to qualify to get it closed. Your closing costs are substantially lower than really just about any mortgage. And I can't speak for every state, but I'll say in my home state in St. George, or my home state of Utah, closing costs are usually only $2,000-3,000. They're really not bad at all. The downside to the HELOC is the payment. And the reason this is a downside is because your initial payment is interest only. That means that if you want to pay the loan off, you've got to make extra payments. And this is hard for people on a fixed income. Likewise, it's kind of a ticking time bomb because your minimum payment only lasts for 10 years, along with your draw requests. Meaning that for the first 10 years, you can draw and pay as much as you want. But after 10 years, the loan automatically converts to a 20-year mortgage, and your payment will balloon. And the reason this is dangerous is because when people are on a fixed income, surprise jumps in expenses, of course, put them in a tight situation. And so here are my recommendations when I would use one over the other. The HELOC is a fantastic short-term solution. It's something that you would want to use for 1 to 3 years. And likewise, my added recommendation on that is please be careful. Don't do a $100,000 line of credit on your HELOC. You'll never pay it off. If you can keep it to 10, 20, maybe $30,000, that's usually the most realistic amount of money for being able to pay it back down, or even consolidating it into a regular mortgage, as we go through market cycles and interest rates come down again. The HECM is a better long-term solution. If you're going to be in the home for 5 years or more, yes, those upfront fees are prohibitive, but if it's a long-term strategy, that's where you'll see the real payoff of doing a HECM. Not only is it eliminating that burden of a monthly mortgage payment, you're getting that growth rate of that line of credit, but you have that security and confidence that this is your home. Nothing can surprise you. 10 years from now, 20 years from now, nobody can show up and say, hey, get out. This is your home, and you're guaranteed by FHA to maintain it, as long as you, again, live in the home and you pay your basic expenses. And so that's my basic general recommendation is long-term solution, go with a HECM. Short-term solution, go with a HELOC, or even just a cash-out refinance on your regular mortgage, depending on what your current interest rate is versus what the market is. So I hope that's helpful. If you have more questions and you want to dig deeper into this in your situation, just give us a call, 435-359-9000, or visit our website at heritagereversemortgage.com.